Hello class, welcome to this second video in chapter 6. Let's just get right into it. We were talking about inventory. And in video 1, we went through and we talked about the purchases and the purchase discounts. Okay, how to account for them, what affects inventory. On the sale, we need to make the double entry on the sale. Okay, wants to record the revenue at the selling price or the retail price. And then again, to record the cost of goods sold expense along with the reduction of inventory for that merchandise going out. We also talked about gross profit being a big number, which is your sales revenue minus your cost of goods sold. And it's good to know. And all of this is going to boil down to what the amount's going to be when we recorded on it, especially when now we're talking about what our cost of goods sold and our inventory values are going to be on which costing method we're going to use. Okay, there's 4 major costing methods here. There's specific identification. Okay, that's where you can easily identify every piece of inventory you have. So who might use specific identification? Maybe a car dealership. Okay, they might have 100, 200 cars, but each one has a VIN number, so they can easily track that and know what they paid for each one. Maybe a jewelry store. Okay, they're going to know their most expensive diamonds, what they paid for that. So when they make that sale, they can, specific identification means they know how much to charge the cost of goods sold and to remove from their inventory for that individual item. There's also first in, first out. Okay, so that means from a accounting and a costing method only, we're looking at it as the very first products we bought are the first ones we sell. Okay, so if we bought some on the first, the second, and the third and didn't make a sell to the fourth, the first ones we bought, so the ones on the first, we sold on the fourth. Okay, that's FIFO. Last in, first out, LIFO, okay, is the exact opposite. It's the last in, first out from a costing method only. This has nothing to do with the physical flow of goods, only how we're going to cost it in the dollar amounts. So that means if we bought stuff on the first, the second, and the third, and we sold stuff on the fourth, whatever the cost was on the third, okay, that is the one that is going to go out. That's cost of goods sold, okay? And then there's average cost, where if we bought stuff on the first, the second, and the third, and then we sold it on the fourth, we'll average the cost of everything we paid up until that point, and that is what our cost of goods sold is going to be. Okay. Then just kind of talks about the specific identification method and how you would use it. You're not going to see it a whole lot. Okay, but here they know they have 300 units at 16. They purchased 600 units at 18, sold 800 units at 30. Okay, we're not even going to get into that one because you're not going to have to do that one very often. We're going to get more into the first in, first out here. Okay, so like I said, this is not physical inventory is probably going to follow this. If first inventory you buy is probably the first one you're going to sell. But again, we're not talking about the physical flow here. Okay, we're actually talking about the purchase price. Okay, the first in, first out method actually follows what most businesses do in the turn of flow of inventory. Okay, but we're really only worried about the price. Okay, so we always think of prices that are going to be rising. So first in, first out means that we are going to expense the ones that cost us less. Okay, compared to if we just bought some recently, they might have cost us a little bit more in a time of rising prices. Okay, so if we have a lower expense means higher income. So we'll have a higher income and we'll have a higher inventory valuation. Okay, compared to the other methods. So here's an example. We're beginning inventory. We had 300 units and then we purchased and then we made a sale. Okay, Says compute the cost of inventory and the cost of goods sold on October 31st using the FIFO method. So we're going to think about our costing method or our cost of goods sold model here. We remember that our beginning inventory plus all our purchases equals our goods available for sale. Okay. So here you can see we have 48 purchase here, a purchase here, purchase here. So our goods available for sale, that should be the first thing we calculate. We have 23,900. Okay. Now, if I want to determine my cost of goods sold or my ending inventory, I just have to find one or the other. So I can do that by applying the costing method to our units sold here. Okay. So when we sold 800 units, where did they come out of if we're using first in, first out? Okay. So we have to go back to the first ones we bought. So 300 of those units came out of there. And then 500 units would have had to come out of here to account for the whole 800 units, okay? So I have none left here, and I have 100 units left here. When I sell 300 units here, we got to go back again now to the first ones we bought. Well, those are already gone. They're no longer there. I have 100 units left here. So I can say that those aren't there anymore. And that leaves me 200 units to account for, which I can account for all out of here. And I have 50 units left. So if I wanted to determine what I had in my ending inventory, I would have 50 units at $20 each, plus 150 units at $22 each. Okay. And this is kind of what it's showing you here, what I just got to talk about. On this sale, our cost of goods sold at that point, we would have sold 300, all 300 of our beginning inventory, plus we would have sold 500 out of here. So our cost of goods sold would have been 13,800. At that point in time, it's showing us we would add $1,800 in inventory. Here, our inventory went up when we did some purchases. Our inventory went up again when we did some purchases. And then when we made this sale, we had to go back through and find out here. That's how much we were sold there. That was our cost of goods sold there. This is our ending inventory. This is what I was talking about. The 50 times 20 is 1,000. 150 times it's 33,400, 4,300. So if you went back and you remember our cost of goods sold formula, we could have put in 23,900 as our cost of goods available. So that was our beginning plus our purchases. And then, you know, if we subtract out our ending inventory here, that we calculate at 4,300, we get the 19,600 as our cost of goods sold without having to do the multiple calculations, intermediate calculations that were in there. Okay, or you can go through and you can calculate up what your balance is at each point in time. Okay, depending on what the question's asking for, maybe it's asking for a specific point in time. What is the inventory balance as of April 21st? When you'd have to go in and you would be doing all these calculations and you would find out it was that. Okay, last in, first out. See, it's just the exact opposite. We're going to do kind of the same thing. Okay, only the most recent purchases, so the things that we bought last, we're going to expense them first. So in times of rising prices where stuff gradually costs more, that means we are going to expense our highest costing ones, which will make our income go down compared to the alternative. Plus our inventory now is going to be our oldest prices, so it's not going to represent current prices. So our inventory is going to be understated also compared to what it's currently worth. Okay. this rarely coincides with the actual physical flow of inventory. Okay, most people are trying to get their stuff they bought first out and just kind of keep it on a circular rotating basis. It's a cost flow method only. Can anybody think of why somebody would want to use last in, first out? Especially since it's going to create higher expenses and lower their income. I guess it lowers a tax expense. Okay, less net income means less taxes. Okay, that way this is just a little knowledge for you going forward. If you're going to use last in, first out for financial reporting reasons, you have to use it for tax reasons only. Or if you, more importantly, to flip that, because a lot of companies would want to use it for tax purposes, okay, because it would make their income lower, less taxes. But then they have to use it for financial reporting too, which less income is not as attractive to the investors. Okay, so it's kind of a trade-off there. And last in, first out, the US GAAP is one of the few that allow it. I don't believe IFRS allows this anymore. So internationally, you're not going to see this type of inventory cost flow very often. So if we have the exact same question here, so we have 23,900, okay? When we go to look at this, when we sell 800 units here, well, first we're going to sell these first 600 units. Okay, and that's what it's doing here. We're going to sell these 600 units. Then we had 300 up here. We're going to sell 200 of those. So we take 216. So we could have found our cost of goods sold for that particular sale. Okay, we're just working backwards this time. Okay, the 800 units, 600 of them came out of here, 200 of them came out of here. So I still have 100 units at $16 left at this point in time after that sell. Then I do some purchases and purchases. And then I sell 300 units here. Well, if I wanted to calculate my cost of goods sold, I'm selling 150 of those and 150 of those. The last ones I purchased. Okay. So I take 150 times 22, 150 times 20, add that together, and my cost of goods sold. Now I'm at the end of the month. If I've marked all these off, I see I have 100 units left here at 5,000, and I have 100 units left here at 16. And that's what it's showing us here at the end for our inventory balance. 100 at 16, 1,600, 100 at 20 is 20,000. Gives me an ending inventory of 3,600. I plug it into that cost of goods sold model where 23,900 is my goods available to sale, my purchases plus everything I've done equals $3,600, 29,000 minus 23,900 minus the 3,600 gets us 20,300. Our cost of goods sold without having to do all those intermediate calculations. If we just look at our units and calculate our ending unit inventory amount. Okay, and hopefully you can look through these slides on your own. They make sense to you. If not, when we put them in real practice, and I'm doing handout 1 and 2, and I go through this, okay, we highly encourage you to watch those. And hopefully when as I start, you see it up there and me marking it off individually, it'll make more sense and you can understand this concept. Okay, so next, average cost method. Okay, under the perpetual inventory system, it's kind of a moving average because you always have to figure out what the average cost is of the inventory at that point in time in the sale. Okay, so when we're doing average cost, we sell these 800 units. Okay, our cost of goods sold is going to be Okay. Yeah, so when we sell these 800 units, they're coming out of these are what we have first. So first we need to find out the average cost of those. So you take the 10,840 plus, or the 10,800 plus the 4,800 to get a balance of 15,600, and there was 900 units. Okay, so you divide that out. I think they got a decimal point in there wrong. Yeah, it's a comma, but it should be a decimal point. It's $17.33 per unit. Okay, that's what each one costs. So we record our cost of goods sold. It's 800 times 1733. Units wise, we have 100 left up there. Okay, at 1733 each. When you multiply that out, we have $1,733 of inventory with 100 units. When we get to our next sale, we need to calculate that average again. We have the 100 units at 1733. Okay, plus our purchase, 250 times 20, plus another purchase of 150 here. So it gets us a total of 10,033. And now we have a total of how many units available? We have 500 units available at 10,033 or 2066 per unit. Okay, so then when we sell 300, boom, we take out 620, the 6,020, and then we can compute our ending inventory. Again, this one's going to make more sense when we go start working through it. It's hard for me to explain on the screen here, but you're always just keeping a rolling average of the inventory you have on hand. Okay. Here is an example of how determining which inventory method you use. Okay, so FIFO is obviously going to create a higher income. Okay, first in, first out in a period of rising prices. And it also has a higher ending inventory amount. That's a good thing to remember compared to LIFO. Whereas LIFO shows a lower income and a lower ending inventory amount. Okay, you can see the inventories right here. 4,300 for FIFO, 3,600 for LIFO. Okay, income smaller, whereas the average cost is going to split it somewhere in the middle between LIFO and FIFO. Okay, so that's kind of how, if you want to have lower income for tax purposes and kind of but it also understates your assets on your balance sheet. So it doesn't look as good for investors. It might be more practical financially if you have a high income tax expense. Whereas FIFO, I think, gives the most accurate representation of what's actually going on, and that's why it's not, or that's why it's the most commonly used, and not even LIFO is not even allowed overseas, stuff like that. Okay, and all this stuff I told you, boom, it is all under the assumption that the purchase prices are constantly rising. Of course, the opposite for everything would be true if purchase prices were falling. So during rising purchase prices, which is what I'm concerned about, which of these inventory costing methods will always produce the lowest income? FIFO or LIFO. See, even I get them mixed up sometimes. LIFO, I knew there was that one. The last ones we bought, because they will be the highest priced, will be expensed first, which will produce the lowest income. And I'll let you look over the income tax effects yourself. All right, so that is it for chapter 6. Be sure, if you're not understanding those costing methods, that LIFO, FIFO, and that average cost method, be sure to watch the example videos. They were going to come in very handy for this chapter. All right, and I will talk to you all then.